Hello, and a warm welcome to Glint for Gold, the podcast and YouTube video from Glint, the fintech that enables you to buy and use gold in your real everyday life. My name is Gary Mead and I'm editor with Glint. Today I'm delighted to be joined by Jason Cozens, our Chief Executive, and Geoff Blanning, who is a special guest of ours who's here today to talk about what's going wrong in our financial system. Geoff spent more than 3 decades as an investment manager, so he knows what he's talking about. And the last 19 years of those were with Schroders, the asset management company which has got more than $500 billion worth of assets under management. He's spent many years travelling the world, reading research reports and analysing what's going on in the financial markets. So he was latterly at Schroders, he was head of emerging market debt and commodities. So we're delighted to have him here today. Geoff.
Thanks very much, Gary. Pleasure to be here.
So, Geoff, what do you think is really going... And Geoff is, by the way, I should say, he's written a fantastic paper which puts a blowtorch under the Bank of England and also the Federal Reserve. It's called Put Away the Tools Now, Please. And it's a brilliant read. Geoff, what's going wrong with our financial system?
Well, the thing that I focus on in my paper is the central bank's printing money, which is called by them quantitative easing. And
can we call it QE for short?
QE for short,
yeah.
Yes. And that is where, well, on the Bank of England's website, it says that quantitative easing is a tool that central banks like us use to inject money directly into the economy. So that's what they do. They create new money, and they do that because they want to try to encourage spending or to boost spending and investment in the economy, is what they say. And I believe that they have abused their ability to do that in the last 10 to 12 years. And their abuse of that ability is growing by the week, by the month, and it's been irresponsible of them to do so much quantitative easing, print so much money. The biggest risk that we face now is inflation of much higher level than we've seen in decades.
In your paper, you call it reckless money printing.
Yes.
I mean, why is it reckless?
It's reckless because of what it could lead to, and I think it's reckless because it, as I've mentioned already, it could easily lead to very high inflation. And the problem with very high inflation is that inflation leads to a lower standard of living for, I would say, most of the population. As we saw in the 1970s, when inflation gets out of hand, then most of the population, obviously they're earning a fixed salary, they are unable to cope with that rapid rise in prices, and standard of livings go down, fall very sharply. Companies put people out of work, unemployment rises, we get social conflict, strikes, and so on. And I think the excessive printing of money that's where we are leading.
I think it's interesting that they even call it quantitative easing. I mean, I remember back in the 2008 financial crisis, and as a qualified architect, as somebody who'd spent all their life developing digital product as the emerging digital ecosystem evolved, I didn't understand any of the financial jargon. And of course, as the financial crisis was unfolding, and as they tried to fix the problems that it had caused, they came on the news. I remember it clearly. The first time I ever heard the phrase was the BBC, kind of basically coming out and saying, "Don't worry, the government is implementing a program of quantitative easing." And I can't help think that if they'd come out and said, "Oh, don't worry, the government is planning a whole program of money printing," it would have sent a totally different signal into society, because people understand what money printing does, even if it's not, that technical. They've got a kind of visceral understanding of money printing, and it's not good for the economy. And there's plenty of people who still remember the 70s.
Exactly, it's just a phrase to hide what it really is. I mean, they do say on their website it's a way of injecting money into the economy, and I think they could have called it money injection instead of quantitative easing.
But this money injection is going on. Where would you say most of all, in the UK or in America or all around the world?
It's going on everywhere. All the major central banks have been doing it. Some slightly more, some slightly less, but on the whole are roughly at the same level. They started after the global financial crisis, 2008. They started in 2009, and there was really, they really had to do it in 2008 because all the major banks, particularly in the UK and the US, were bust. They had leveraged their balance sheets way beyond anything that they'd done in history, and asset prices were collapsing. And if it had been allowed to continue, they would have all had to close their doors. So that was obviously, that couldn't have been allowed to happen. So one could argue the central banks did the right thing at that point. They had to save the banks, and they had to stop the runs on banks, and they had to rescue the financial system. So in the past, in history, that's what quantitative easing has been used for. It has been either used in time of war, when there's been extreme need for boost to the money supply, or in a financial crisis. The problem was that after 2009, they continued to do it. The initial intention was that they would print this money, and then once the banking system is stabilized, the money would then be withdrawn. But that never happened. Instead, what happened was an emergency policy started becoming just a conventional, regular monetary policy, and that's where the problem. That's why the problem lies today. They've used quantitative easing for fine-tuning of inflation management in the economy, and it shouldn't be used for that.
So, Jason, do you think that monetary easing, this quantitative easing, this money injection has done any good?
Well, I think my biggest concerns are the effect it has on society, because this money injection doesn't generally happen. It isn't distributed evenly, is it? I mean, it's given to banks. My understanding of it is that it's given to banks. It is then lent out by the banks. I know you've got some comments and thoughts on that as well, Geoff, but it's then lent out to people. And banks do not lend it to everybody equally, and there has been some of that recently with COVID, where they give effectively helicopter money, just like throwing out helicopters to people who needed it to be able to keep them in their jobs under the furlough schemes. But generally speaking, over the period that we've seen this QE, it's given to banks, it is lent out to people, and generally people who don't need it. If you go to the bank and you're desperately in need of money, you can't really normally borrow it. You have to have sufficient means to be able to pay it back. Obviously, you generally have to have quite a substantial deposit. I mean, if you want to buy a house, then you might need anywhere between 5 and 25% in order to borrow the money to buy the house. And so what you get is a situation where this huge amount of free money that's been injected into the system goes to those people who already have money. They find it very easy to borrow more money. And what do? They go out and they buy assets. They go out and they buy houses, they buy businesses, they start investing in the stock market. And of course, this drives up inflation for this group who see the prices of housing, the stock market exploding, not exploding, the wrong word, bubbling, turn into a huge bubble, generally assets going up in price. And what that's doing is driving those things out of the reach of what I call the have-nots, or the ordinary people. And it's very sad to see that. When you meet somebody and they say, this has happened to me, I just met perfect strangers in restaurants, and talking to them, they've said, look, I've given up on the idea, especially young people. I've given up on the idea of ever owning a house. Of course, those people coming through are going to get fed up with that. So I think either it drives pressures for inflation because they start demanding more money, or if that isn't forthcoming, then of course it leads to huge unease and a huge feeling within that massive community of have-nots, of total disenfranchisement with the system. And I think that the last time that we had such a big gap between the haves and the have-nots was during just before the French Revolution, and we know how that ended. Didn't turn out very well for the haves.
Yeah, the worsening inequality has been, plain because, so as Jason said, if you've got assets, it's fine. Asset prices are going up. That's one of the stated objectives of the central banks in printing money. They want to boost the wealth effect, they call it. Well, it's okay if you're wealthy to start with, but if you don't have assets, you don't benefit at all. So.
I just noticed the other day that house prices in the US have gone up 20%, almost 20% over what they were last year. I mean, this is remarkable. It's astonishing. I don't remember anything like this ever happening before.
I mean, in 1 year, it's crazy, and the obvious reason for that is because the Federal Reserve has increased the money supply by 25% in the last 12 months. So no surprise that property prices have gone up over 20%.
And you see in San Francisco now that there's just a huge explosion in the homeless, and I'm not an expert in it, but there's got to be some impact from these rising house prices in an area which has seen one of the greatest areas have seen the biggest impact from this rising asset prices. And of course, Silicon Valley, the whole place is full of people who are benefiting from their rising stock options and share prices of their tech companies. And of course, that leaves a whole generation of people who are left out from that.
I mean, do you see asset prices? I mean, we all know that the stock markets have soared in valuation over the last 12 months. I mean, how do you see this all ending?
Well, I think that what's going to happen is that consumer prices will play catch up. So, what we've had is the money printing so far has gone into financial markets and it's gone into property markets. And it hasn't gone yet into the real economy. So, for example, since the Bank of England gained its independence in 1998, consumer prices have only gone up 55% since then. I mean, it's still quite a lot, but 55% since December 1998. But the broad money supply, so that's basically all the bank deposits, everything that that people have that they could easily use to buy something, cash has gone up 270%. So, to my mind, in history, typically, money supply has gone up 1-for-1 with inflation. We've been in a period in the last 10 or 20 years when consumer prices have not matched the rise in inflation. Consumer prices have not matched the rise in broad money growth.
Right.
And all that means is that they're going to play catch up at some point. That's always what's happened in history. So what I say is that the inflation has already occurred. So there's latent inflation in the system. And so the potential for consumer prices to rise rapidly is very much there. And that's why I think the central banks are playing a very dangerous game right now, because we know that consumer prices are already rising now. So in the US, consumer prices are over 5% already year on year. In the UK, the official number is only 2%, but I think that's going to go up substantially in the next few months. And what's going to happen is that consumer expectations of inflation are going to rise. They're all rising already. And once that happens, then people's behavior changes, and people start expecting increases, and they start, buying things in advance and stocking up on inventory. Companies stock up on inventory, because they know the price is going to go up next year, and so on. And once behavior changes, then it's very difficult to stop it. So I think what's happening now is that it won't necessarily happen this year. We might just get rising prices and then some fall back next year. It doesn't mean it will happen now, but the potential, because of this huge imbalance between the massive increase in money that we've already had and consumer prices, which have been very well behaved so far, that gap has to close, and this could be the time when it starts to close very rapidly.
Right.
And a lot of the banks, and especially in the US, are calling it hyperinflation. They're using that in some of their descriptions of what's going on, but they're saying it's transitory. They're saying it's transitory hyperinflation.
That's Jerome Powell's favourite word these days.
Yeah, and it's being caused by there's pent-up demand and things like that. I mean, that's obviously very confusing for people who are listening to our videos and right now trying to understand what's going on, because you can understand the logic around a little bit of pent-up demand and how that might lead to some transitory inflation, or how supply chains have been affected by COVID and everything. What would you say to that kind of argument that's out there?
Yes, I mean, hyperinflation is something quite different. I mean, the definition of hyperinflation typically used by economists is 50% a month. So we're nowhere near that. But the central banks do say this is transitory. That's the word they keep using, and they all use the same word. There's very much a kind of groupthink amongst central banks, which I think needs to be broken, really. Yeah, transitory. It could be. It could be that we've just got some supply chain problems, and once they sort themselves out, as the virus goes away, prices fall back. But as I said, the danger is that this rise in prices gets into expectations and changes behaviour. It takes a long time to change consumers' behaviour from one kind of regime to another. We've been clearly in a regime of the last 15, 20 years where most people didn't expect high inflation. They did expect prices to remain relatively stable, and that's the way they behaved. But right now, if they suddenly see prices up 8% or 10%, which I think is easily possible by the end of the year, then their behaviour will change. And I think that's why the central banks, they're really playing with fire to let this happen. Because I think even though they don't understand money in the way that I understand it, in terms of this long lag between money growth and inflation, because they say we haven't seen inflation yet, so we're not going to get it. And I say, well, that's not how history of inflation worked. History of inflation worked. There was always a catch up eventually with prices, but they do understand. I mean, they do and talk about consumer expectations, and that's why I'm so surprised right now that they're letting this happen. I think they should be acting, sharply.
I wanted to ask you, Geoff. I mean, we've all grown up as sort of economists in an era when conventional economic theory held that you had to control money supply to prevent inflation. But now we keep hearing about modern monetary theory, MMT, or as not Mrs. Thatcher, Mrs. May called it the magic money tree. We could just carry on printing money because we control it, so therefore it's never going to affect anything in the economy.
I mean, I think that just goes against history. I mean, but you're quite right. That's what people think. So the governor, the chairman of the U.S. Federal Reserve, Jerome Powell, I quoted him in my paper. He said, there used to be a connection between monetary aggregates and inflation, but that hasn't been the case for a long time. I don't think he's studied history properly. I think, as I said, it can be years or decades sometimes when there's no effect, but eventually there's a catch-up, and I think that's what will inevitably happen. And it's not just me saying that. I mean, the Bank of England former governor Mervyn King wrote a paper which was very clear, which showed the historical one-to-one relationship using 30 years of IMF data, showing how there's a very strong link between inflation and the money supply over the long term, not over short periods. And also that there's very little link between money growth and economic growth. So printing more money isn't going to produce higher economic growth. All it's going to produce in the long term is higher inflation. And the European Central Bank has said the same thing. They've said, there's the connection between money growth and inflation. It's hardwired into the economy, is what they said. And they said that as recently as 2016, I think. So some people in these central banks understand this, but they're obviously not in charge of policy.
Right. And I suppose they've got a problem, which is to stimulate the economy after COVID, isn't it? That's one of the challenges they've got. But as you say, the problem is they never came off the quantitative easing, and so in a way they've lost their weapons. Do you think? And therefore they're having to use rhetoric, for instance, to manipulate markets through PR to try and stop inflation or keep it down by threatening that it might come. Is that how you see it?
I think you're absolutely right about they're trying to manipulate markets. I think their weapons can they actually affect economic growth at all? I mean, I think that's a question that should really be asked. I think the people's belief is that they can, that they do have power. But I think what they really affect is financial markets. I don't really think they affect economic growth very much at all, because growth occurs for other reasons. But so more money definitely gooses financial markets, and it particularly has goosed the bond market. So the thing that they never talk about when they talk about, well, they might say, well, yes, the stock market is quite highly valued, or property prices are quite highly valued. They never talk about how highly valued bonds are, where we have at the moment, 15 to 17 trillion dollars worth of bonds around the world which have negative yields. And this is when inflation in the US is 5% and rising. We've just seen the highest inflation in over 10 years in the Eurozone. Yeah. And so on. And government credit quality, we're talking about government bond yields here, is deteriorating rapidly, because all the governments have taken on a huge extra increase in debt in the last 12 to 18 months. So we have rising inflation, deteriorating government credit quality, but we have most of the world's bonds trading at zero yields. So this is the most overvalued financial asset possibly in history. And it's not going to stay there. So, I think more and more investors will realize that there's just no point in holding these assets. And when they do, then they start looking for something else. And people generally buy, this is what happens in financial markets. People buy what's going up. That's why people are buying various cryptocurrencies right now. I can't profess to understand those at all. I don't buy them, so that's because I don't understand them. But they're going up, so a lot of people do buy them. And but gold is also going up, has been going up for the last few years, and I think more and more people will buy gold for that reason, because it's easy to understand gold, and when it's going up, they'll buy a lot more.
You touched on debt, and one of the things about inflation is that it's quite useful for reducing debt, isn't it? The US has now a federal debt of $28 trillion. Yeah. So the US is quite happy to have some inflation, surely.
Absolutely. That's the traditional way out of high debt, is to inflate it. That's what countries, politicians, central banks have done in history, and it seems like that is the road we're going down.
I think just some of our viewers might not understand what bonds are. We just talked a little bit about them there. Can you just explain to really layman's terms what those bonds are, and just go over a little bit about what you just said in very simple terms?
I think it's quite important, if I can interrupt, because the Fed is buying $80 billion worth of bonds a month right now. And $40 billion of mortgage-backed securities a month.
Yeah, so what a bond is simply a loan which is traded in financial markets. So the Fed is buying $80 billion of government bonds. It means lending $80 billion to the government every month. But it's not actually lending it. The money that it gets to lend, it's actually just creating. It's just printing. So, if you lend money to the government, you have to take it out of your bank account and lend it to them. The Fed just creates it out of thin air, a touch of the, on the keyboard, $80 billion. And that's what they've done. They've done $5 trillion of quantitative easing in the last...
the Fed's balance sheet is now over $8 trillion. Yeah.
And then the mortgage-backed securities?
Well, it does the same. So a mortgage-backed security is a loan for a house purchase, and it's the same thing which is traded on the market.
So the banks who lend money to people for their mortgages, they're all being packaged up and being bought by the Fed.
By the Fed, yeah.
So sounds very similar to the problems that created 2008.
Yeah.
It's really quite incredible, really.
How do we get to this position? Sorry to butt in, Jason. How do we get to this? surely these are clever people in charge of governments and central banks. They're trained economists by and large. How do we get to this position where they seem to have taken their hands off the tiller?
I think there are a couple of reasons. One is it suits a lot of people, for them to go on printing money like this. It suits the governments because they want to see, politicians want to see economies doing well, so that if there is a short-term benefit, obviously, to new money being poured into the economy. So we do see some benefit in the short term. I think we see big disadvantages in the long term, but as I mentioned. But the other thing is, I don't think they've studied economic history properly, particularly when it comes to printing money, because the history of money printing is that once you start, it's very difficult to stop. And that's when they did start in 2009, there were lots of people who said this is a very dangerous road to go on. There were people who said that, and of course that was dismissed because it seemed like they really had no option at that time. But the problem is, why did they continue? And one of the reasons in the UK is that the government sets the objective of the Bank of England, monetary policy objective, which is to produce 2% inflation every year without fail. And that means if they underperform, if there was zero inflation, that's a problem. They've missed their target. So most people would normally worry about higher inflation, but they've had to worry about too low inflation as well. So, how do you get inflation? How do you get prices up? Well, the obvious way to get prices up is to increase the supply of money. And that's what they've done. And I think this is a problem. I think their objective is wrong. And that's why in my paper I say, the first thing the government should do in the UK is change the objective of the Bank of England. The Bank of England could argue, well, we've just been doing our job. The government told us to produce 2% inflation. When we thought inflation was going to be, less than 1%, we had to do something about it. And the thing that they thought to do was to print money. So, but I think that's obviously misguided.
Sure. It's slightly different in the US, where the Fed has a dual mandate. It's got to ensure full employment. It never quite defines what that full employment is. Yeah. And it's got to ensure monetary stability. Yeah.
So the Bank of England could just argue that it's been doing what the government told it to. It's been preventing inflation less than 2% by printing money. But, I think obviously that's been a misguided policy.
Yeah. One of the signs that Jerome Powell constantly looks for is this reaching full employment. Difficult to know what he means by that. It's never defined. But one of the dangers that some people have talked about, such as Nouriel Roubini, who I like and admire, have talked about the dangers of stagflation, not inflation or deflation, but just a kind of crippling slowness in the economy, which is combined with inflation. Do you see that as a danger?
Yes, I agree. I think that's where we're going, because I think we're going to see a repeat of the 1970s, where that's where we had recession and inflation at the same time. And this is something that in this, most of these central bank economists, they don't really accept that can happen, which is why I say they haven't really studied economic history, because their model of predicting inflation is based on higher growth means higher risk of inflation. But so therefore, if you have very weak growth, you must have low inflation or deflation. But we've seen many times in history that we've had periods when we had low growth or a recession and inflation, and we've had periods when we've had high growth and no inflation. That's what you might expect, right? If you suddenly invented a machine which cut the cost of producing a car by 50%, that would be a huge growth in productivity, and prices of cars would fall, and you'd have high growth and lower prices, and that's what we should be aiming for. But that's not their model of inflation.
And in some countries they need that to happen, don't they? They need in Japan they need to have technology delivering productivity for their population, which is increasingly aging, and they want robotics. Asia's very keen on robotics. I see Boston Dynamics just got sold to a Korean company, And you know, the science fiction books that I've read are all a world where it's become very deflationary. You know, as you said, technology should drive everything down. Our standard of living has been going up, but I fear our standard of living has been going up for the last 50 years because we've exported that inflation, not because of great advancements in technology. So the microwaves and the computers that we've had built have all been created in countries such as China and India, where the population was willing to work for wages a lot smaller than what we were experiencing in the West. Of course, those countries have seen a massive growth in the middle classes, and people are not willing to do those things cheaply anymore. And I was just talking to somebody in fashion the other day, and they just said, "Oh, embroidery is just not for anymore. It's just not for mass market anymore. I mean, just forget it. I mean, it needs to be hand embroidery is for, you know, ultra high net worth type products because it's not going to happen for the mass markets." That's just one example. Of course, then what happens is these skills get lost, of course, as well, which is a different subject. But we've been exporting this inflation, so that's one reason we haven't felt it, because microwaves haven't been going up in price. So the products that we use have been made cheaply, but surely, yes, they're going to try and find places to get them done cheaper. They'll be moving them factories to Indonesia and other places to try and do that. But eventually, the whole world ends up having this. It's a good thing, kind of equality in standards of living and stuff, and that inflation that to have things made goes up unless we start automating things, unless we start using robotics and science. And I just wonder, surely that's got to have a very deflationary effect. And going back to your comment about full employment, at some point the model's got to change, because at some point people don't want to, in a society where, you know, robots are creating everything for us, we don't want to work. You know, we want to go on adventures and join Elon Musk in trips to Mars. But I
mean, the Fed shouldn't have, and they shouldn't have the objective of full employment, because, you know, they should have the objective of maintaining, you know, the value of the currency from one generation to the next. And if they actually just did that, then, you know, you probably have a very, very positive environment to create strong growth. But growth is created by other things, you know, by people willing to work hard, by innovation, by how you put the factors of production together, by tech, you know, government changing policies on tax and that kind of thing, and also by saving. And then that's one reason why we've had such high growth in Asia, is because they still have very high savings rates, whereas in the West we've been encouraged not to save. The central banks have, you know, this policy of very easy monetary policy, that they really trying to promote out and out spending, consumption, and if you do that, then you've got zero interest rates, you're obviously not saving anything. And the only way you can raise your standard of living is by putting money aside, by foregoing, you know, current consumption in order to put money aside to invest it to produce these productivity gains.
And the word moral hazard comes into my mind right now. Presumably, can you kind of define what that is, or, you know, I certainly see my interpretation of things, moral hazards everywhere as we move into this, you know, consumerist society that's driven by this credit culture and the need to buy and consume, which doesn't feel to be doing any good for the environment or any good for society. But effectively, you know, you've got governments and central banks making decisions that are distorting the economy, and decisions are happening right throughout society which otherwise wouldn't have been made. Is that
exactly
right?
I mean, it's hugely distortive to the economy. Again, that's why one thing I say that in my paper, that the government should try to encourage the Bank of England to promote savings rather than consumption, because that's how we will increase our standard of living. At the moment, whatever investment takes place, basically it's just borrowed. It's borrowed or it's printed. It's not, you know, say our savings rate is so low that we're not actually investing properly.
And the money, I mean, I keep banging on about this in nearly every opportunity I can get, but in my lifetime, the pound and the dollar have lost more than 85% of their purchasing power. Just think about that. The pound and the dollar, and most other currencies as well, have lost more than 85% of their purchasing power. They've become nearly worthless. and anybody designing a currency surely would think that's not a very good form of money. And that's what, for instance, brought me to gold. You mentioned that before, because it's in my lifetime the purchasing power of gold has gone up by more than 500%. I think that's why it's driven us at Glint to be on this mission, a mission that's driven by an altruistic view that we want a world where everyone has an equal opportunity to prosper. We're not going to get governments to change their policy, because I think, as you said, politicians don't want to make these tough decisions, do they? They don't want to be known as the person who stimulated the taper tantrum, I think they've called it, and the danger of us going into another recession, and they don't want to get involved in anything like that. All they want to do is stay in power. They just want to get re-elected, and of course they're just kicking the ball down the road for someone else to deal with, and of course that's just making the problem bigger and bigger. And so we have to take control of our own lives, I think. We have to, and what Glint we're trying to do is give people choice, and one of those choices is to have a form of money which insulates you from these problems, to be able to insulate you from the destructive effects of inflation that we've been talking about, and also we haven't talked about systemic risk. I mean, presumably that this is also creating a problem within the system, and that if it's not brought down gently, you think it's going to potentially, it could explode, and that's not a very good thing for society, is it?
No, I mean, I think explosion like 2008, I don't think will happen, because that happens for a specific reason, that the banks were so leveraged. So the moment their asset prices started falling, they were exposed to a vicious cycle on the downside. But today it's a different problem. The banks are actually very well capitalized, and they've got too much money. And so that's why the risk is inflation. The risk is that money gets used. So, for example, probably a bank economist would say, central bank economist would say, well, there's no risk of the banks employing those reserves rapidly now. What are the growth opportunities? There's no risk of the runaway inflation. But I say that banks always find a way to employ that money. They're profit-making enterprises. So I read in the paper just recently that Lloyds Bank, major bank in the UK, has just decided that it's going to now enter the UK property market directly. So they're going to buy 50,000 homes, using up their £4 or £5 billion of their balance sheet, which is not something they've done before. So don't think it'll just be Lloyds. Now they're doing it, all the other banks will do it as well. So, property prices are going to just keep going up in the UK for that reason alone. They'll probably become the biggest owner of property in the UK.
This is all very scary. I mean, I have to ask you, are you scared?
Well, I'm very worried, because, that's why I wrote the paper. I'm very worried about the inflationary potential. As I mentioned, I think, the prices could easily double or triple. I'm not saying 5% inflation. I'm saying 100%. Prices could easily double or triple if we get into this cycle of rising expectations. And again, there are many examples in history of that happening. We say, there's a phrase in financial markets, slowly and then all at once, right? That's typically how debt crises happen, because once trust is suddenly lost and people start getting worried, then it spreads like wildfire and everyone suddenly wants their money back, and you get a crash. Well, it can happen. People don't realize the same thing can happen with inflation on the upside. The hyperinflation in Germany in the 1920s, and I'm not saying that's what's going to happen here. Obviously, there was particular circumstances there as well, but that the major acceleration of inflation happened within 18 months. So once behavior changes and psychology changes, we already have the inflation. It's already there in the system. It's just not in the right. It's in the financial markets, most of the money, rather than in the real economy.
But you see it transferring to the real economy?
I think it's inevitable. I think it's. I read. The best explanation I've heard, was from a book called The Death of Money, by an author called Jens Parsons, and it was written in 1974. And he described it as reservoirs. He says, well, there's a reservoir which is of money in the real economy, which people are using for transactions on a daily basis, and then there's another reservoir of money in the financial markets. So he said that they're connected, but they're not very well connected, because most of the time, well, if we're in the situation we've been in the last 5 or 10 years where the money is being printed by central banks, that money is going directly into the financial markets. The central banks are buying government bonds, and it's staying there. That's why the financial asset prices have gone up, the stock market, the bond market, and so on. And prices in the real economy, goods and services, have not changed very much. But at some point, the people begin to realize this can't go on forever. And the valuation, the advantage of switching some of your money, saying, well, this asset I'm holding is overvalued. I'm not going to make any more money. And in fact, I might lose money if it goes down. The balance of risk changes. And you say, well, I'm going to take my money out of the financial market, and I'm going to put it in something over here in the real economy. And that, when that shift starts, it can then accelerate, which is what I'm saying. I think there's a risk we're about to see an acceleration of that. And it may not be. We may not see it for another 5 years. But it's inevitable that the kind of dam bursts between the two, and eventually inflation will skyrocket. I don't think anybody could say that the money print, the growth in money supply that we've had so far will have no inflationary impact in the long term. I think it has to be the case.
And here at Glint, we do think that gold is the security against a lot of these things. What's your opinion on it? I
agree 100%. I think throughout history, certainly me to tell you this, gold has been the asset which people have held in times of uncertainty and in times of inflation, and it has held its value. And I don't think there is any other asset which is like that. So
not cryptocurrencies.
I mean, I just don't know about cryptocurrencies. There's not much history. As far as I can see, there aren't any barriers to entry. I mean, Bitcoin has been successful, and a lot of people will tell you that that's the place to put your money. It may maintain its value in the future, but I'm not I'm not technical enough to understand. And also, but I do know that other people can set up cryptocurrency. You can set up as many as you like. There's no barrier to entry. So why should Bitcoin become that one asset? That's the thing about gold, is there is no real competing asset to gold. So
I need to ask you a personal question. What do you put your money into?
Well, given what I've said, you might not be surprised to hear that most of my investments are in precious metals.
Right.
I mean, I would say, I've always held some, because it makes sense to always hold some as an insurance, because you never know what's going to happen. The only thing you get for free in investment is diversification. Diversity, that's the only thing that's free. You have to spread your assets around. You have to so always hold something in precious metals, and gold in particular. But today, I think the risk, well, given what I've said, the risk is so high that we see a kind of runaway inflation like the 70s that I've probably got more in precious metals today than ever.
Right. And people who are kind of all gung-ho about the stock market, is the danger for them is that they won't see it coming? Will they? Is it too too fast for them to move into more stable, more secure?
Blindsided by transitory.
I mean, a lot of my friends are like, oh, it's not.
There'll always be some people who make money in the stock market. There'll always be some companies that are growing, and their stock prices will go up. You've got to do a lot of research to find those companies and to follow them on an ongoing basis. So it's really a professional's game.
But even with the professionals, presumably their job is made even more difficult because of the distortions.
Absolutely.
Yeah, and just the Fed needs to come out and say something, even just say something, not even do anything, and that kind of.
And the biggest distortion is interest rates, because they're artificially depressed, right? Suppressed. And obviously, if inflation does go up, when I think it will, then interest rates will follow, and then equity valuations will be challenged.
So, Geoff, I mean, how do you see this ending? Is there going to be an end to this, or are they just going to carry on snowballing the ball down the road?
Well, it will end, obviously, eventually. I mean, the way I see it panning out is that, inflation, either now in the next few years, or in a few years' time, it's inevitable. As I said, inflation will pick up sharply in a number of different countries, and then we'll see some reactions. Obviously they'll have to react in some way to those the problems that's causing. But from my experience in investing particularly in emerging markets over 30 years, is that typically real reforms don't happen until it becomes a real crisis. So they might talk about the problems and they might make some limited changes, but that won't solve the problem. And so it'll probably take 2 or 3 or 4 goes before eventually real tough monetary policy regime changes take place, and that will happen in different countries at different times. So I'm hoping that the UK will start. That's why I wrote the paper, that the people here will get the message and will start to do some reforms here before others. But we'll see.
What hopes do you have that Rishi Sunak, the Chancellor of the Exchequer, actually might listen to you?
Well, I don't really know, because I've never met him. But I am aware that he has heard some of these arguments. I mean, that's one reason why I wrote the paper, because I thought, well, maybe there's an half-open window to the possibility of some reform here. I think there's no chance of a reform like that in the US at the moment. Really? I think it's very clear that the central bank is absolutely committed to what they're doing.
Well, I mean, the Federal Reserve is even talking about, or people are talking about, Lael Brainard becoming the replacement for Jerome Powell as chairman of the Federal Reserve. And Brainard is a well-known left liberal.
Right.
I mean...
Yes, for the Democrats on the left of the party, the current Fed chairman doesn't have an easy enough monetary policy, which is insane, because the policy that they have at the moment is infinite quantitative easing. There's no end date at the moment.
No.
So I don't see how you can get really easier than they are at the moment. So it's quite extraordinary.
Yeah, I mean, I think these problems are going to affect everyone. They're not just going to affect the people who've worked hard all their lives and saved, or it'll also affect the people who are trying to save. There might be someone who's trying to save for 10 years to try and save up a deposit for a house, and they can't do it, because by the time it's got 10 years' time, the value of that money isn't worth the percentage of deposit that they need to put down on the house anymore. And so again, I think, look, governments are not going to do this very quickly. They're not going to do it within their own. Governments are not going to implement any fast changes, as Geoff has said, and therefore I think it's up to us to all take our destiny into our own hands. And that's why, for instance, as I said before, we here at Glint believe that gold is that security. It defends you from history shows that although the value of gold can go up and down, of course it does, as confidence in fiat currencies and paper money goes up and down, so does the value, therefore perceived value of gold go up and down. But really, gold is consistent, hasn't changed in terms of it hasn't changed. It's the same thing that was created when 2 neutron stars collided, and that's why we rely on. It can't be quantitative eased. It can't be split into 2 different types of currency, as you can with tokens, with Bitcoin, when the miners get together and decide they disagree. It can't be corrupted in any way. And so what we're doing at Glint is, we're the key, we think, to giving you that security. And so I do encourage you to download the app and try Glint out if you haven't already, or if you've got it and you like it, tell your friends about it. Also, this is one of our first YouTube video interviews. We've migrated from our podcast to video, and I'd encourage you to subscribe at the bottom of the video, so that you'll get reminded next time we do a video, and come on and listen to us again. Do give us your feedback. It's really important to us. Yeah.
Thanks to Geoff, and thank you, Jason.